Well, the July CPI report showed inflation is moderating. Both headline and core CPI rose 0.2%, driven mostly by rent and food prices. But is it still too soon to declare it a win for the Fed and its goal of a soft landing? San Francisco Fed President Mary Daly weighed in earlier on Yahoo Finance.
It is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target. We don't control gas or energy prices or food prices, but definitely by bringing demand of the economy back in line with supply, we're going to get broader inflation relief. And that's going to be the thing that, I hear it mostly. I have 9 states in the Western United States. I can talk to any single person. I ask them, what's your number one concern about the economy? They still say inflation. More work to do.
Joining us now is Gus Foshay, chief economist at PNC Financial Services Group. Gus, good to talk to you today. You heard Mary Daly there sort of saying that the Fed's job is certainly not over yet. When you look at annual core inflation, we're talking 4.7%. So what does today's data today tell you about how sticky that last 2.5% or so is going to be to get to that 2% target?
Yeah, it's going to be difficult to get down to 2%, and it's going to take a further slowing in the labor market. On the good hand, however, we do see that inflation, core inflation outside of housing services, is falling pretty quickly. But housing is still an addition to inflation, and strong wage growth is still a problem for inflation. So I think it'll take some further softening in the labor market to get that core inflation back to the Fed's 2% objective.
Gus, do you think the Fed needs to hike again in order to get more softening in the labor market?
I don't think so at this point. We are seeing slower job growth. We are seeing wage growth ease off a bit. And I think that monetary policy at this point is still quite contractionary. The Fed funds rate is between 5.25% and 5.5%. That's weighing on economic growth. And I think given the slowing in inflation that we've been seeing, the slowing in job growth that we've been seeing, the Fed can keep the Fed funds rate there in the near term. And then if need be, they can raise it towards the end of 2023 if it looks like inflation isn't slowing as much as they expect.
So what does this all say about what the outlook is? In the grand scheme of things, we keep talking about the soft landing, but it really is about avoiding a recession while trying to pull back or actually cool down some of that inflation. It is starting to come down, but as we noted at the very top, we're still off that target for the Fed.
That's right. And again, monetary policy is still contractionary. It's still weighing on economic growth. I still think the most likely outcome is we get a mild recession starting in late 2023 or early 2024. But there's still close to a 40% probability that we get out of this with weak growth, but not an outright recession. So the Fed has been dealt a difficult hand. I think they're doing a reasonably good job of playing that hand. But the most likely outcome is recession, but there's still decent chance we can get out of this with some bumps along the way, but not an outright recession.
Gus, how are you looking at the uptick that we've seen in gas prices? We've seen a pretty significant surge over the last month, and I guess how much that's going to potentially complicate the Fed's fight with inflation, at least in the short term?
Well, I think you heard President Daly say that they don't have much control over energy prices or food prices. So I think that they're going to look through that. I think we'll see a supply response that brings energy prices back down again. I think the Fed is much more focused on core inflation because that's what they feel they can affect. So I don't think that that's a big issue for the Fed right now.
You don't think higher energy prices are a big issue, even though that could potentially reaccelerate inflation?
Again, I think the Fed is more focused on core inflation, which is moving in the right direction, albeit slowly. And then I do think that any increase in energy prices is likely to be temporary, and the pass-through to core inflation is going to be quite limited.
Gus, when it comes to, and we're very far from talking about potential rate cuts or what that conversation will look like, in order for the Fed just to start potentially talking about it, what do you think, how much more progress do you think they need to see?
I think that they need core inflation that is back down below 3%, and we're a ways from that now. We will get some help from housing. I think we will get some help from a softer labor market, but unless we see a very substantial deterioration in the labor market in the near term or inflation that slows much more dramatically, I think we're probably 9 months away from a rate cut.
So, Gus, we're obviously looking ahead to that next FOMC meeting in September. But in between that, we've got the Jackson Hole Symposium in a few weeks. Does the messaging change at all, you think, at this point, given the data that we've gotten, or is it still pretty consistent in terms of the Fed trying to keep optionality?
Oh, absolutely. Obviously, there's a lot that could happen to inflation, to the labor market over the next few months. The Fed has said that they're going to be looking at the data. We heard President Daly talking about that. And so I think that, the Fed will indicate that they're not planning to hike in the near term, but that if inflation doesn't slow as much as they're expecting, or if the labor market continues to run strong, that they are willing to raise the Fed funds rate in order to get that inflation back down to 2% over the longer run.
Gus Foshay, it's good to talk to you today, Chief Economist at PNC Financial Services Group.